Well, despite it being a shortened holiday week last week, we saw plenty of green in the stock market, which is very likely from all the hope and optimism that's been brewing amongst investors, giving way to more market momentum. But before I kickstart into today's video, I certainly hope each and every one of you had a very meaningful Thanksgiving well spent with loved ones. And now I also sincerely want to express my personal gratitude as this channel continues to grow, because it's just been an honor and a privilege to sit here on a week-to-week basis with all of you and discuss economic insights and stock ideas, all of which hopefully delivering value to you. However, we have plenty to cover today because we have a lot of optimism in the market. I want to cover why we have that optimism and what we should think and feel about it, on top of 7 dividend stocks worth your attention right now before the end of the year. With that, let's dive right in. So investors, 2023 flew right on by.
The future has finally arrived.
And now here we are about to close out the month of November, thus entering the last month of the year. Now, this year, 2023, has been quite a roller coaster ride, and I'd really like to think that all of this hope and optimism that I'm alluding to is really just a delusion of the reality that we'd like to be living in. Now, as mentioned, the shortened holiday week led to higher highs in the stock market, as I'm sure investors will now be trimming their positions to take profits soon, or, well, at least that's how it typically goes on these extended holiday weekends. However, we're going to get higher volume trading to follow, so just be aware of that. But that is now not the economic reality I want to talk about. What we really need to be well aware of is the Federal Reserve. Why? Well, after the release of the latest FOMC meeting minutes, we saw commentary alluding to and suggesting to more interest rate hikes to come our way, which would severely impact the market. Of course, much of the commentary was actually rendered before the release of the CPI report, which ultimately depicted that inflation had notched down to 3.2%, which is a good sign, but the question is just now back on the table. Will Powell and the gang raise interest rates again, or are they anchored in the position that their previous hikes were actually all that was needed and would suffice? You see, the last time the Federal Reserve actually took their foot off the gas pedal, inflation ticked back up, which is not what they wanted nor what our wallets wanted to feel. And now we have this, of course, 2% inflationary goal that they remain steadfast on hitting, and it's just very likely that the Federal Reserve could continue to act aggressively. Now, what we need to understand is that the labor market could withstand that aggression, and the Federal Reserve's next meeting is on the 12th and the 13th of December, so just be cautious, keep your head on the swivel when it comes to the Federal Reserve disappearing into their blackout period, because again, more volatility is likely. However, does any of that, what I just mentioned, actually matter for you as a long-term investor? Not really. But it could help point you in the right direction, to which now I want to go over 7 hot dividend stock picks to buy before December, all of which are safe investments with solid dividends, growth rates, or the jackpot of all 3. So let's go ahead here and kick off with the safest bet on today's list. It's lacking a bit in the dividend growth area, but delivering on everything else. We have Kimberly-Clark, ticker symbol KMB, which is in the business of manufacturing personal care products and consumer tissues. We're talking about paper towels, toilet papers, and baby wipes, with some of their leading brand names being the top shelf brands like Huggies, Kleenex, Kotex, and Scott. But by no means here does that make Kimberly-Clark decline resistant. And a matter of fact, when investors go growth, the stock actually tends to fall, to which we're seeing it right now down 8% in the year, trading for $122 per share. The rather low PE ratio here for Kimberly-Clark at 23.2. Now, I do want you to recognize just how much the stock ebbs and flows through the cycle. Zooming out to 3 years here, we can see that plenty of ups and downs have occurred, but ultimately led to a longer-term win of over 63% worth of growth over the last decade. And while it may not be much, analysts do still foresee near-term upside here of 3.23%, coming up to $126 per share. But as a long-term dividend investor, here's where the win really comes in, with the Dividend King delivering over 50 years worth of dividend growth at a rate of 3.43% and a current yield at 3.88%. Now, as for this next dividend stock opportunity, it's equally as important for our society and quality of life, though in a much different capacity. We have Genuine Parts Company, ticker symbol GPC, which is a distributor of automotive replacement parts as well as office products and electrical components, all of which are really unknown to the average Joe. But as mentioned, it's a play like this that just plays a paramount role in all of our lives, so it might be a boring investment, but boring often means lucrative, especially when the stock itself is down by over 17% in the year, trading for $137 per share at a PE ratio of 15.5. Now, that's quite a steal if you're a buy and hold type of investor into this juggernaut that's appreciated over 124% over the last decade, with still more upside forecasted by analysts, coming up to a share price of $149 per share. That's just about 8% worth of growth here. Now, insiders are equally optimistic about Genuine Parts' future, so we see them buying, and hedge funds who have already actually begun buying more shares last quarter. However, it's the dividend insights that really get me and boost my confidence, with over 66 years worth of dividend history, along with a growth rate here at 5.73% and a dividend yield holding strong at 2.76%. But if Genuine Parts Company is not exactly suitable enough for your portfolio, I feel an investment in one of the largest global pharmaceutical companies very well may be. So let's dive into Bristol Myers Squibb, ticker symbol BYM, which only continues to drive industry-leading drugs into the market to fight against cancer, HIV, cardiovascular diseases, diabetes, hepatitis, and arthritis, all of which will likely be around, unfortunately, until Kingdom Come. And it's in a company like this that we can invest into very reliably. Now, we get the opportunity when the stock is down to take full advantage of it. Right now, it's down by 30% in the year, trading for just $49 per share, with a P/E ratio at 12.4, with quite a growth history here. We can look to see over 27% worth of growth over the last 10 years. Now, analysts have a forecasted share price coming in at $63.36 per share for Bristol Myers. That's over 28% worth of upside, and bullishness with over 2 million plus shares purchased by smart money last quarter. Yet, let the dividend bulls now come out and play with this one, because we're looking at a growth rate of 7.34% and a yield that's coming in just under 5% at 4.7%. Now, investors, if you don't necessarily want to invest on the big pharma end, you most definitely should continue to look into the healthcare sector and have this one on your watch list. It's a medtech player manufacturing industry-leading medical devices. But before I actually cover this stock, I do want to know if you're actually getting value from these dividend stock listicle type videos. That's all you have to do to let me know is just tap on that thumbs up button, and then I'll be sure to keep making videos just like this one. With that, we're going to get back to it here and cover Medtronic, ticker symbol MDT. As stated, it's in the medtech space, and most importantly to note that the company has just been struggling since 2020. That's based on supply and demand shifts, higher interest rates that are bootstrapping hospitals, and of course just with budgets cut across the board. It is a play like Medtronic that would really be severely impacted, and that's what we're seeing here. It's down by 23% on the year, trading for $78 per share. Yet zoom out to discover 71% worth of growth over the last decade. And on top of that, there's a very special treat on behalf of analysts who remain bullish on Medtronic, with a target share price popping all the way up to $86.78 per share. That's over 10% worth of upside, with, get this, over 4.2 million shares purchased by smart money as of last quarter, likely for the longer term, to really just hold on to Medtronic, as it's going to play an instrumental role for us all. But let's now dive into the dividend insights, where we can see a beautiful 7.37% 5-year growth rate, as well as a dividend yield coming in strong at 3.51%. And if you're not necessarily in the business of saving lives, some might be in the business of, well, say it more optimistically, defending lives, with Lockheed Martin, ticker symbol LMT, which is personally one of my preferred investments, as it's the largest defense contractor delivering arms and defense systems to the US government and allied forces, which means that we're always really going to be in business here, and business will be booming. As we can see, a $100 million deal was just struck between Lockheed and the US Army, another with the Air Force for over $238 million, with some more icing on the cake here with a $503 million Army contract, all within the last few weeks. And in knowing that Uncle Sam will remain locked and loaded until the end of time, for better or worse, this is an investment that should certainly be on our watch list at bare minimum. We see it now trading for just $450 per share at a PE of 16.4. But as mentioned, Lockheed is an explosive growth player. No pun intended there. 315% worth of appreciation over the last decade. Analysts predicting 7.8% worth of more upside to come. That leads to a share price of $485.70 per share, and hedge funds are continuing to load right back up on it. And better yet, we have a dividend warlord here on our hands, with over 20 years worth of dividend growth, delivering 8.45% worth of dividend growth, and a yield coming in at 2.81%. Now, I get it, Lockheed isn't on everyone's love list, given the nature of what they're in the business of doing. But that now leads me to really say that I hope you're not too stuffed from Thanksgiving here, because we have Tyson, ticker symbol TSN, the largest beef, chicken, and pork processor out of the United States, and the second largest processor in the entire world. So I don't want all of you balking too loudly at why this stock made today's list. Now, I get it, it faces a lot of scrutiny rather recently, but I think our macro environment just has a lot to do with the share price depreciation. For example, animal feed costs shot way up, and logistical fees increased. Tyson was just gobbled up and all in the middle of all of that, thus explaining a 22% year-to-date decline, with the share price coming in at $48 per share. Now, give it time because it's likely going to rebound and come in strong. As noted over the last decade, Tyson's actually experienced over 81% worth of growth. And while I do want to share with you, I do feel bullish on Tyson, I want to say it will probably take time to recover, especially if it doesn't buck right out of these negative news headlines. However, we do have smart money investing wisely into the company with over 3.8 million shares purchased already, but don't let the rebound prevent you from enjoying its dividends immediately, because we're coming in with a 5-year growth rate at 9.86% and a current yield at 4.09%. Next up, another investment that will not only rebound but soar contingent upon the housing market shifts. Let's talk Lowe's, ticker symbol LOW, which is one of America's leading home improvement retailers that has gained some momentum within the last few years here, but ultimately still faces the hardships from our macro environment, and it's down by 3.9%, trading for $198 per share right now, the PE just above 20. But zoom out over the last 5 years for 147% worth of appreciation, another 5 to see almost 400% worth of growth. But now, if none of that jazzes you up, take it firsthand from the analysts who are very bullish and forecasting plenty of growth, coming up to a share price of $227.67 per share. Now, I think you can get even more excited when you see these hedge funds that have begun to buy back into Lowe's, starting with Evergreen Advisors, Echo Street, Gamco, and Invest. However, all the hedge funds aside, we have Lowe's dividend insights that are coming in very strong, just a powerhouse of a dividend player, over 60 years worth of dividend growth at a whopping rate of 19.29% over the last 5 years, with a dividend yield holding strong at 2.22%. Now, investors, let me know your thoughts on any or all of these dividend stocks with a comment down below. Certainly join me for more dividend stock ideas right here. But before you go and click away, be sure you're subscribed to the channel to never miss another dividend stock idea.